Now that we've examined the various regulations applicable to cryptocurrencies, I'd like to discuss a variant of cryptocurrency known as initial coin offering, or ICO, which is the process whereby a digital token is created on a blockchain as part of a decentralized software protocol. ICOs rose to prominence in 2017 and continue to be a prominent source of fundraising for startups that have yet to launch their product or service. We will discuss the regulations applicable to ICOs in the next lecture, but we first need to understand what ICOs are and how the market has evolved. Initial coin offerings allow companies to raise money by creating and selling a digital token on a blockchain in exchange for cryptocurrency, typically Bitcoin or Ether. Some blockchain tokens function as a digital currency. Other tokens can represent a right to tangible assets, like gold or real estate. Blockchain tokens can also be used in new protocols and networks to create distributed applications, and these tokens are sometimes referred to as app coins, utility tokens, or protocol tokens. And then there are some initial coin offerings that are intended to be nothing more than a speculative venture. Most initial coin offerings are conducted on the Ethereum blockchain, which was designed to support decentralized applications. Why would a company issue an ICO? Well, the biggest benefit is that it provides an economic incentive for your network to get off the ground and overcome the classic chicken and egg problem. In other words, it gives all users of your app or software the ability to own a little piece of your network, incentivizing them to start using it from the beginning. This gives the network a higher chance of success with a lot less initial capital needed. There are essentially two types of ICOs, pre-release and post-release. Pre-release ICOs have historically been the more common and can be conducted in fiat, digital currency, or some combination of the two. As the name implies, pre-release ICOs occur when a project needs funds to develop a product or service. Post-release ICOs occur when a project has launched an initial version of their protocol and corresponding token and wants additional funds to continue its development. Now let's review the steps that should be followed if a company wants to issue an ICO. Note that I said should. Not all ICOs will follow these exact steps, but doing so will help maximize the funds raised while also staying on the right side of the applicable regulations, which we will discuss further in the next lecture. Step 1 is to publish a detailed white paper that describes the network you are trying to build and what it will be used for. The white paper should provide a clear and compelling reason for the digital token to exist, provide a detailed technical description of the proposed project implementation, and set clear expectations for total token supply and distribution. Step 2 is to provide a detailed development roadmap that will include estimates of time and cost for each stage of the project and the names of key members of the development team and their advisors. The roadmap should allocate funding for each stage of development and consider restricting access to funding until milestones are achieved. Step 3 is to use an open, public blockchain and publish all the code for your project. This provides transparency and enables real participation from token holders and independent developers. Step 4 is to use clear, logical, and fair pricing in the token sale. This includes setting the maximum number of tokens to be sold in a crowd sale and using a pricing mechanism which does not increase over time. Step 5 is to determine the percentage of tokens to be set aside for the development team to reward them for the work they put into the project. And the final step, or warning if you will, is to refrain from marketing the token as an investment. Tokens promoted as investments most likely qualify as securities, subject to SEC registration. We'll talk more about this in the next lecture. But for now, just know that most token issuers do not want to register with the SEC. Prior to 2017, initial coin offerings were essentially unheard of. As we can see in this chart, at the beginning of 2017, there had been $300 million raised all time through ICOs. By the end of 2017, $5.86 billion had been raised through ICOs. In December of 2017 alone, $1.4 billion was raised through ICOs. This remarkable growth in ICOs is hard to explain. Certainly the massive increase in the value of cryptocurrencies that occurred in 2017 played a big role, as did greater familiarity with and adoption of blockchain technology. However, just like with cryptocurrencies, human psychology has played a major role. Many people have been buying ICOs simply because they think they can sell it for a higher price later and could care less about the token's underlying utility. Thus, it is possible the ICO market could be in the midst of a speculative bubble, and if the SEC were to deem all ICOs to be securities subject to SEC registration, the bubble would quickly burst. But as we will talk about in the next lecture, thus far the SEC has taken a more measured approach to regulating ICOs.